everyone. Just apologies as well for the confusion with the timing today. It seems a bit of a miscoordination between GA and guys, but we got there in the end. I'm just going to share my screen. Because of the slight tweak to our approach here, we didn't have time to do an audio test. So can you guys watching on, can you just let me know in the chat, make sure that the audio is coming through okay and you can see this this screen here? That'd be great. Perfect, thank you. Okay, awesome. Cool, guys. So look, today we're going to be talking about how to avoid some of the most common and most painful money mistakes, some of the things that you can do to, the things to look out for so you know what to avoid. I'll give you some hacks as to how we can, how we can avoid that. And then what I'll also do is take you through a bit of a framework around, or three frameworks actually, specifically around some of the things that we can do once we've avoided these mistakes to actually get on the front foot. So for anyone watching on, please, going to be plenty of time for questions. Feel free to shoot them in the Q&A there, and we will jump on. And I'll have plenty of time to circle back to those at the end if you're thinking it. Chances are that there's probably a handful of people that are thinking it too. So yeah, feel free to shoot those through. Guys, please, before I jump into the content, don't rush out and make any life-changing decisions off the back of the presentation today. Would strongly encourage you to seek out personalized advice before jumping in. You should be doing that when you're making big decisions with your money anyway. So, guys, look, before I get stuck into these mistakes, I just want to call out some common challenges that we've seen that people face, because we know that everyone's situation is unique, but there are some common challenges that people face when you're trying to, get ahead with your money and go down that asset building, wealth creation type journey. And I've got them up here. The first one is this information overload, and it's just so much information out there that it's almost like we're drinking from the fire hose, and it's really difficult to know who to listen to and who to trust. Everything's just a keystroke away with Google and stuff these days. So it's all there, but it's there in volumes and volumes. So a lot of conflicting opinions, hidden agendas, and mixed messages out there. Now, the second is that people struggle to find a real balance between how do you get your money, bubbling away and growing at the rate that you want while you're still able to live a great lifestyle and the lifestyle that you want as well. And then the third one here is FOMO, which is the fear of missing out, and a term that I have a trademark pending on, which is FOFU, which is essentially the fear of fucking it up. Now, I find that when people come to make these decisions, that they think about, especially the bigger the numbers get, the more scary it is to actually take action and to do things, because you don't want to be that person that does the dumb thing that ends up making the mistake that costs them a bunch of money. So we end up paralyzed, and we end up in this situation where we're sort of like stuck, and it's stuck, not always stuck doing nothing. Sometimes just stuck doing the same thing that you've been doing in the past. And what that means is that you're missing the opportunity to be getting better results, to be getting more out of what you have now. So there are three elements that you need to get right, and I'm going to go through these in a little bit more detail after, but essentially structure, which is about making it easy to save, make it easy to manage your money, make it clear what money you have to work with when it comes to savings, investments, whatever. Strategy, which is setting clear goals and targets, understanding the pathways that can take you from where you are right now today to the exact position that you want to be in. And then solutions, which is the investments and strategies that back up your plan, things like raise, and shout out to those guys that we're putting this event on in partnership. We'll talk a little bit more about some of the compounding things and the power of investing, but essentially making sure that you're getting reliable, consistent progress and avoiding the chances of setbacks and momentum killing mistakes when it comes to your investments and your product solutions. And these three elements you need to get right. If any one of them is missing, it ends up dragging down the others. If you're good at saving, got a good strategy, but bad investments, you blow up your cash. Good strategy, good investments, bad at saving, you're working with the leaky bucket. Good at saving, good investments, no strategy, leaving money on the table, lacking confidence, stressed out as well. So I'll give you a bit more detail around some of the frameworks that we've found to nail those as we go through today. But before we get there, I'm going to go through some mistakes, and I've actually separated the mistakes into 3 categories. I've got some minor mistakes, then I'm going to go through some of the major mistakes, and then I'm going to talk a little bit about some of the myths. Now, the first one when it comes to the minor mistakes is unconscious prioritization. And unconscious prioritization is essentially, well, like prioritizing in the moment. And what a lot of people don't tend to realize or identify is the fact that good money management, good financial strategy, good financial planning, not financial planning with a financial planner, but good financial planning for each of you guys watching on there is setting the perfect priorities. You know, we've got priorities. You know, we want to enjoy the day. We want to enjoy the moment. We want to be able to travel. We want to be able to get ahead financially, and we don't want to have to work forever. And we want to invest. We want to invest without too much risk. We want to buy property. We want a nice roof over our heads. So the perfect strategy for each of you guys is really getting those priorities in the perfect order so that you're getting the right thing at the right time. And the problem is when it comes to priorities that we're always prioritizing, but we're not always doing it consciously. When you're at the pub with your mates and you order that 3rd round of drinks and shout everybody at the table, you've just prioritized something. You prioritize the enjoyment in that moment. Or when you make an impulsive purchase, or it could be any number of things, but you're always prioritizing. And because we're sort of hedonistic, pleasure-seeking creatures, we can fall into the trap of prioritizing unconsciously in the pleasure in the moment. But that pleasure in the moment is often inconsistent with what our real priorities are. Because if you go back to this 50,000 foot level and think about what's actually important to you, that you might think that, well, getting ahead financially is important, and building wealth, and you want to get that financial security, the emergency, the war chest to a certain point, and you want to be able to have that freedom and peace of mind. But then you walk down the street and the dopamine receptors kick in, and we prioritize in the moment. So the key to avoiding this mistake is to ensure that that you are consciously prioritizing at the 50,000 foot level. So you've got to take a step back and think about what's actually important to you. Then what you need to do is have a framework for your day-to-day money management that's consistent with the priorities that you've set here. So leverage the power of small barriers. I'll talk a bit about the banking framework that we use that allows or that supports you in doing that, I'll say. But making sure that, you've got an approach that's consistent, that it makes it easy for you to ensure that your actions in the moment are consistent with your bigger picture priorities. Really big one, super powerful. Another mistake that people make is not separating their savings to spend versus their savings to save. So this is common when people are trying to build up, savings and cash assets, that you end up, you put all your money in one big pile, which seems like a good idea. And then you've got a nice, bigger balance there. And that makes you feel good in that moment. But when you have your longer term savings, like your savings for, say, a property deposit or your emergency fund war chest or whatever, mixed in with the savings for things like, travel or things you want to buy around the house, that you actually are never really crystal clear on what, how much money do you actually have in your war chest versus how much do you have that you plan to spend on other things. And when you mix up that money together, again, it sort of ties almost back with the previous point about prioritization, that we want stuff, we can see a big balance there. So you end up prioritizing the wrong thing and you end up saving much more slowly. So the key there, it's a pretty simple one, is just make sure that you've got a separate savings for your long-term savings to your short-term savings. Super duper helpful. Waiting to save more until you have a higher income. This is a common one that I see. And look, there are some cases, I've been talking to a bunch of people that have been impacted with COVID and stuff, which, you end up in a tricky spot for a while, or sometimes when it comes to time out of the workforce, family, having kids, all of that sort of stuff, that it is extremely challenging to save any money at all. And sometimes you're actually dipping into savings. Now, that's the sort of a thing on purpose, and putting that to one side for a second, even if your income is lower or not where you want it to be, that you want to make sure that you're always prioritizing you're always making sure that you have some level of savings in place. Now, that it's the key foundational element to money success. Spending less than you earn is one of the most powerful strategies, if not the most powerful strategy that you can employ. But again, we have this tendency to ratchet up our spending and our lifestyle over time when it comes to we get paid more and then we end up spending more, and it's like people defer this savings to this never that just never comes, and in the meantime they've missed the opportunity to start building their momentum. Thank you, Cleo. Is that someone said that the audio, is that audio coming through, guys? You can see it for the guys that are watching on. Clipping? Yeah, okay, perfect. I'll just turn that gain down. Thank you, Cleo. So next one is around not keeping good records around your tax. And tax is, we pay a lot of tax in Australia. So, you don't want to pay, tax is important, but you don't want to pay any more tax than you have to. So making sure that you're keeping good records around your tax is something that's super, super helpful. And something that's going to save you a bunch of money over time. Now, you want to make sure that the best time to plan with your tax is right now, obviously, but we want to just make sure that we're keeping the record so that when it comes time to tax time, that you end up that you've got all the records there to take maximum advantage of the things that you've got. The next one is about making choices in isolation, and what I mean there is that people, and it's one of the most common questions that I get asked by socially as a financial planner, is people will say, "I've got $10,000. What should I do with it?" And my response is always the same, that it really depends. The right investment decision, it really depends on where you're at now, how your situation's likely to change over time, and the things that are important to you there as well. So you want to, when you're making financial decisions and financial choices, looking at a choice in isolation, you're only going to get part of the picture. So that the answer, as I said, is it always depends. And you want to make sure that when you are making your money moves, that even something that's good in absolute terms could be the wrong thing for you. The right move at the wrong time is still the wrong move. So you want to make sure that your money investments and choices are going to fit with the broader strategy and the things that you've got coming up. And then the last one that I've got here in the minor mistakes is setting and forgetting. Now, these days, everything is changing so fast. Like, technology is changing. The world is changing. We're seeing so much rapid change with the COVID situation and the stuff that's happening around that. Unfortunately, it's not like, generations historically have just, you buy a house on a block of land, you pay it off, and that's essentially your strategy. We can't do that now because everything is evolving so quickly. So it's great to have a great strategy, but once you have a great strategy, there are 3 things that you need to make sure remain consistent with the strategy that you've set. Now, the first one is around making sure that your what's going on with your money. The second is what's going on in the world and financial markets. And the third is what you want and how you feel about stuff. Now, you want to make sure that all 3 of those things remain in alignment with your plan. And then that means that the plan is the very best plan for you. As soon as one of those things, though, changes in a way that makes it inconsistent with your plan, that's a time that you need to update your strategy so you can continue to make sure that you're on the front foot, taking advantage of all the opportunities that are ahead of you. So some of the bigger mistakes that we see, the first one, and this one sounds like something that's minor, but in fact, it's one of the most important things that you need to get right when it comes to your money. Now, money is one of these things, money is one of these things that is really important, but it's never really urgent. It's like our health, relationships, physical fitness, nutrition. And this is why we tend to be overweight as a nation, because eating that extra serving of food or that ice cream or treat or something is more pleasurable in the moment than being prudent and responsible with our dieting and nutrition. So it's one of these things that it's money. You need to make it a priority. You need to make sure that it is you're making it a priority, because it's not something that will happen on its own, and you need to make the time to continue to make that work, moving forward, and prioritize spending the time to get the money results that you want. Not looking ahead is a really big one. It's funny, I was just having a conversation with a client just before, and talking about the power of actually just mapping out, if you keep doing what you're doing financially, what are the likely outcomes that you're going to achieve? Like, what are the likely results that will happen based on what you're doing? Now, how we do this is with using financial modeling software, where you plug in, your situation today and start to look ahead, and that gives you a baseline that you can then start making decisions over the top of. If you buy this property, if you do this investment, if you do sell the property, crank your super, do these other things, that you see the impact of the decisions that you're making, so that you can, that they're the very best ones for you in the moment. And because, this time, the impact of like the momentum element of time and money, that the easiest time to course correct is right now. So if you need to change something, you want to be able to see, if you wait a year, 5 years, 10 years, you might look back and say, geez, I wish, if I had just pushed a little bit harder, or if I just saved a little bit more strongly, that you would have got an even better result. So that power of taking the time to look ahead is something that is enormously beneficial for making decisions, as well as, ensuring that you're going to be close to ending up in a position that you're happy with over time, so that you can course correct as needed. Investing for tax purposes alone, this is another one that can cause a lot of problems for people. People don't tend to think about the potential for the tax rules to change, and therefore their investments to no longer be appropriate. And where this particularly comes in is around property, and I see, and it's a real bugbear of mine, there's a lot of these property spruikers out there that talk about these off the plan properties where they get these enormous tax benefits, and they talk about this positive cash flow investment, and the investments, the people get blinded by the tax incentives and end up choosing an investment which is a substandard investment. Now, you should never invest for just tax purposes alone. It's always you want to make sure that without the tax benefits, that the investment stacks up. Otherwise, it was never a good investment to begin with. The next one is another tax issue, which is around not tax planning before you invest. And look, for employee individuals, so for PAYG employees, as in for non-self-employed people, that the biggest opportunity for you to save tax is around when you invest. If you start investing or start building an investment portfolio without being super mindful of the tax considerations of that investment, it's very difficult to unwind and change things in the future. Very difficult, because there's capital gains tax implications and restructuring implications and costs and stuff. So you just want to be mindful, when you're buying assets, buying investments, buying property, buying shares, whatever, whose name is it in? What is the tax plan around this? What is the tax, the tax intricacies of that specific investment, and how can you set them up to get maximum advantage? When you do that and do that front end, you are going to save yourself literally tens of thousands, hundreds of thousands, potentially millions of dollars in tax savings over the course of the investment, or over the course of your asset building and investment journey. Another one, and this is pretty common with our engineer crowd, around seeking the the best option, and getting stuck in that analysis paralysis trap. I see a lot of people when we used to do physical events, and I suppose I do get it a bit on the Q&A, that people talk about, doing all this number crunching in spreadsheets, looking at different yields on different investment types. And, what about the yield on Mossman versus Surrey Hills versus Neutral Bay? And it's like, look, no one knows what the best investment is until after the fact. No one. And so the only way that you can actually choose the best investment is if you get super duper lucky. But the paralysis that happens when you try to choose the best often delays you taking action for an extended period of time, and that delayed action is extremely costly. It's the opportunity cost of doing something else. So sometimes settling for something that's really good as opposed to the very best thing that we never know about until afterwards and have to suffer through the delayed reaction form is gonna cost you a bunch of money. So settling is good. In this case, it's one of my least favorite words, but sometimes that settling for good is going to provide you with a much better financial benefit in years to come than waiting for this best thing that we never know about until after the fact. Waiting for the right time is another one that we see, that people like, oh, when this thing happens, when I'm just going to get married first and I'll spend the money on the wedding and then that'll happen, or I'll just get this pay rise or promotion or this other thing will happen, and waiting for the time and delaying action in getting started. And there's no right time. The best time, and in fact, there is a right time. It's 10 years ago. The second best time is right now. So delaying for this other thing that doesn't happen is just gonna cost you money down the line. And then the last one here is going it alone and trying to figure all this stuff out yourself. I think going it alone, you end up learning by trial and error, which is something that takes a long time and costs you a bunch of money, right? So sometimes you just need to get started, but when it comes to, making bigger investment decisions, setting your broad investment direction, the products, buying property, like these things that are large decisions, that having someone in your corner is going to save you a ton of money, cut down a lot of that trial and error timeline, and mean that you can, you don't fall victim to your psychology, you don't miss taking advantage of opportunities, and gives you full confidence to pull the trigger on stuff when you should be pulling the trigger. Also gives you the insights to not pull the trigger when you shouldn't be as well. And both of those things are things that can save you a bunch of money. And I just think I get that people think that money should be easy, but it's its own thing. So sometimes having the right help to get everything set up in the right way is insanely valuable. Obviously, we're a bit biased because I see this every single day, but I think for the benefits that are there massively outweigh the investment that you would make in getting some good support, whether it's financial advice, having the right mortgage broker, property people, property buyer's agent, all of that sort of stuff, accountants. These people there should be profit centers and pay for themselves, not things that actually cost. There is an initial investment, but you get that back many times over. So guys, the last thing I want to go through is some of the myths. The first one is around needing to shoot the lights out with every investment that you make. I'm going to show you actually an example as we go through here with this stuff and the power of time and money. But wanting to shoot the lights out with every investment is something that's really built into our psychology. It's something that we see, or something that I see a lot, that everyone has those stories of their mates and on Facebook or social media or Reddit, and we've seen a little bit of that lately, where you're always comparing yourself with someone else, and it's never good enough. But you see with the compounding, and I'll share this example with you, that being smart, being consistent, like our objective, if you want to get to a certain point, what you should be thinking about is, how do you get there with the highest degree of certainty possible? Not how do you get there as quickly as possible, but you run a 50% chance of blowing up your cash and having to go back to the starting line. The next one here is that everyone, and I see this day in and day out, that everyone thinks that everybody else has it more together than they do when it comes to their money. That they're more on top of things, that they're more organized. We talk to people and they say, oh, I bet that answer is really vague, or I bet everyone else is so much clearer on what they want. I think everyone's in the same position, because it's hard to know what's even possible if you haven't taken a really structured approach to planning out your money stuff before. Good goal setting. People think about setting goal. I need to set some goals first. Goal setting is not an action, it's a process. You need to think about, big picture, what's important to you. Then you got to go, well, based on that, what's realistically possible based on where I am right now today? Then you refine from there and set your final ultimate goal once you know what's possible and what you can actually do. So yeah, everyone's in the same boat. And this is the other side of this coin, is that everyone says, I wish I should have started 10 years ago. And I think I mentioned before that the best time to start is always 10 years ago, but the second best time is right now. And, I'm guessing people in the General Assembly community, I find generally a bit, you got a lot of time until like retirement. Not that it's about retiring, but like that's what the typical retirement age is. And when you're thinking about setting yourself up to be financially free or financially secure, then you have a lot of time to go through that asset building journey, such that you don't need to chase returns or kick yourself, because I find that sometimes people they end up kicking themselves, and as a result they end up not taking action, and then they end up not in the position that they could otherwise be in. The other thing, and I think I mentioned this already, but people think that because you get paid money into your bank account every week or month or whatever, that money should just be easy. It's not easy. It's its own sort of area of expertise. I was looking, when I wrote my book, I was looking, and there are like 10,000 different options when it comes to investing just in Australia. And that's, worldwide, it's many multiples of that. So it's hard to know what are the perfect things, and it's not something that should just be straightforward. And then, yeah, this last one here is one that I've actually just started calling this out, because people don't realize that being successful as an investor is not about just choosing good investments. The most powerful thing, there are one of the most powerful things that you can do when it comes to investing is your investment plan, like the strategy around that. I mentioned tax savings on investments. What's the timeline with your investments? How does it fit with the lifestyle that you want to live? How does it fit with your broader asset building and wealth creation strategy? So you can have a good investment, which is good, but it's not going to be good for you. And it can be good, but it cannot be the best thing, or you end up leaving money on the table as a result. So you need to put strategy first, be smart, and you're going to be well placed to do much better than someone that just focuses on choosing a good investment. Guys, I hope you found those mistakes helpful or useful in learning, so that you know what to look out for. I just want to run you through now some of the elements of money success, and it ties in with the three elements that I mentioned that we've found that you need to get right. Now, I'm just going to run through each of them in turn. The first one here is structure, which is all about making it easy to save and make it easy to manage your money, as well as making it really clear what money you have to work with when it comes to savings, investments, debt reduction, whatever. So this model is sort of driven by the fact that when it comes to allocating your money, that you've essentially got two choices. You can allocate it to your spending today, and you can allocate it to your spending in the future. Your future is about like savings and investments, so cash savings, shares, property, paying down debt, etc. Now, with cash and your cash war chest is really important, but it's not all. Any assets outside of that, just leave it at the door, buddy. Thanks. Sorry, that was my postie just dropping off a package. Anything outside of your savings they're medium to long-term investments, share portfolio, property investments, these things that they're not, you don't want to buy them one day and then be forced to sell them the following day. You would never want to be forced to sell them at a time that you weren't expecting. And if you do that, you can allow good investments to do what good investments do, which is make your money. So how you do that is you just want to make sure that you're never forced to sell. You're never forced to sell investments at the time that you weren't expecting. And how you do that is making sure that you've got the spending that you want to provide for and the today side of things taken care of. And there are only so many types of expenses that we have. You have your fixed costs, rent, bills, are boring stuff. Then you got your spending, that's your walking around money, meals, entertainment, etc. Day-to-day discretionary stuff. Debt, which is your debt. Everyone's least favorite category, but an important one to knock over. And then you got your lifestyle, this is your short-term savings that I mentioned before, your savings to spend. I used to say it's your travel fund, but who knows when we'll be able to travel again. Now it's more like your, home toy fund to keep everyone entertained during COVID. But there are only so many types of expenses that you can categorize here. So when we do this, we actually just run these as different bank accounts. And the first step is actually to map everything out. I don't really like the B words that much, but you got to do your budget. Look at how are you allocating your money, make sure that it's consistent with what's important, make sure that you're saving enough. And then this is where that prioritization piece starts, right? You just put it, look at what's there, figure out, make sure you got the right priority set for you. And then we actually just structure this into multiple bank accounts so that you can automate all of the transfers so that you've got all of the money flowing to where it needs to be, right money in the right time, essentially. If you do that, you're going to leverage some of and this is what I was talking about initially, we're talking about the prioritization of your income and your spending and how you're spending your money, that circling back and making sure that you've got the right mix between lifestyle today, these discretionary things, not having too much in terms of your bills and stuff, but so that you can save at a decent clip is going to be super powerful and mean that you can get ahead at the rate that you want. Now, the right rate here ties in with that looking ahead piece, and I'll talk a little bit about that when I get into the strategy as well. But I've used this savings system with hundreds of people and found that it makes it really easy to save, manage your money on a day-to-day basis, leverage a lot of the psychology hacks and principles that we can sabotage with, and makes it really clear what money we can direct to other strategies for actually building and growing your assets and wealth, like investing, buying property, etc. The next one I want to go through is an example around investments, and I'm going to step you through some of the numbers that essentially this is about starting a regular investment plan with $0 today. So basically, you start with $0 today, you save $10 per day, and invest into the share market average. Just $10. Now, the long-term return on the Australian share market is 8.7%. So actually, I think I've mixed up these two examples, but essentially this number here is about saving $1,000 a month or $12,000 over the year, right? So you save $12,000 a year. Over the first 10 years, you save $120,000. With the 8.7% return is the long-term return on the Australian share market. At the end of the 10-year period, you should have the initial 120 grand that you put in, plus you've got some growth on the investments, $70,000. So the total is $190,000. Now, this is based on the last 10 years. So we know that the past doesn't predict the future, and I was never here, this never happened. But if you would have done this 10 years ago and put in 120 grand over the last 10 years, you'd have $190,000 today. If you would have started 10 years before that, so kept it going for 20 years, you put in a total of 240,000, but you see that the growth is now significantly increased. We've got, instead of the first 10 years, we got 70,000 in growth. The next 10 years, we get 400,000 in growth, maybe 400 less than 70, but the total growth is 400,000. So there's a significant increase. Now, if you keep that going for 30 years, that's 360,000. We've now got 1.7 million. So your growth is like 1.4, almost 1.4 million bucks. So you see that it's really, and this is the power of compounding interest and the power of getting started as well. That's 40 years, we've got $4.2 million, which is, that's massive. One, like that's a lot of money. But that would allow most people, or in fact, if you didn't necessarily need a rock star lifestyle, that is going to be enough for you to live on. the rough rule of thumb, guys, so when you're thinking about your savings and asset building strategies, is that you should be able to draw about 5% from a portfolio of assets without eating into capital. What that means in human words is that if you've got $1 million invested into a diversified investment portfolio, you should be able to draw about $50,000 every year without eating into the $1 million capital base that you started. And it should be inflation adjusted as well. So at $4.2 million, 40 years, we've got 200 grand income in perpetuity, essentially. So guys, sorry, this is this is the power of taking action and the power of getting started, because I see a lot of people that end up sitting on their hands and not taking the action that they need to get the results that they want. And you see that the difference in every 10-year period, the difference in getting started now versus today, if you can keep it going for 30 years versus 40 years, we're more than double. Every period, you're more than double the better off by starting sooner. So this is my motivational pep talk to say, make it happen and start building the momentum. Your future self will definitely thank you for it. The last piece here is strategy. And I think this is where it all sort of ties together, which is, you want to make sure when you're planning, it's not about just making smart decisions. You want to make sure that you've got a solid strategy that has the smart decisions incorporated with the lifestyle that you want. So you're making the right moves at the right time. Now, how we do this, and this is the process that we guide people through when helping them with their money, but it's the same process that anybody needs to use to help with their finances. Now, essentially, the first step is to focus in on what's actually important to you. What are the key considerations? What are the decision points? What are the things that we need to actually do to get the results that you want? From there, we want to wind it into understanding all of the moving parts that are going to impact your plan. What money's coming in, what money's going out, where's it going? Let's stress test that. What's your current asset position, your investments, the gains position, the tax situation, all of the things that are going to impact your plan. Then we want to clarify the lifestyle baseline, which is what are the things that over the short to medium term, you absolutely want to make sure that you have the ability to do if you choose to do them. Then that allows you to look at the different strategies, which are what are the financial moves that could make sense based on where you're at. Let's look at I find that, at this point, people are pretty open to exploring stuff because we're not agreeing to actually do anything. We're just agreeing to explore some stuff. And then you want to understand what the options are and explore those options. And I think when we do it, we use that. This is where the financial modeling software kicks in, where you can look at those different scenarios in a bunch of detail so that you make sure that you can see the impact, the financial impact, and assess that alongside the non-financial impact. Where are we comfortable? Where are we stretched? Where are we maybe being a bit lazy and could potentially be pushing a bit harder? I find that when people see what those scenarios look like, that you're generally going to be drawn more to one particular pathway than the other. A pathway that gives you the right balance between the peace of mind, the confidence that you want, and the stress levels that you want as well. Where you're comfortable, where you're stretched, and what's right for you. Then you want to understand the different elements that sit underneath the strategy. Savings and banking, let's optimize that. Investment plan, what does it look like for you? What is your personal investment mandate? What is your super fund, etc.? From there, put it together into the action plan, which is just like, what are the steps that need to happen to turn this great strategy into great outcomes? Then you want to set up and automate as much as possible so that you can get the results that you've planned for. 6 is about where that ongoing piece kicks in, and it's about making sure that what's going on with your money, what's going on in financial markets in the world, and what's happening, what you want and how you feel about stuff remain consistent with the plan that you've set. When you go through that process, you're going to be well placed to get the best outcomes from your planning, maximize all of the opportunities that are available to you, but also have real clear visibility on where you're headed and making sure that you're happy with it, which in turn leads to a lot of confidence. Really, really key. It's not just about investing or avoiding mistakes, but I think those outcomes are super powerful and something that everybody should really have. So guys, next steps, just before I crack into some Q&A, next steps, and anyone watching on, if you've got any questions about the stuff that we've covered or anything else, feel free to just whack them into the Q&A box there as well. So I just want to leave you with this model around the 4 futures, which is essentially talks about your progression from where you are today to this future state. And basically it says that in this future state, you're going to be in one of 4 positions, essentially ranging from really bad to really good. We've got distress, which is people that are, you've got no financial options and you're basically stuck and trapped from a lifestyle perspective. Then stalled, where people are making some progress, but it's slower than they want. They're a little bit not fully stressed out, but they've got that niggling thought in the back of their mind that there's some stuff that they could be doing better. Up to comfortable, which is people that are building some real momentum and acceleration from a financial perspective. And then we've got the really technically labeled killing it stage, which is people that are making rapid acceleration from a financial perspective and essentially have no limits on the lifestyle choices that they can make. Now, people think about their progression from where they are today to this future state as a straight line, but it's not, because of the compounding impact of time and money. It's actually this curve. And because of exactly that compounding impact. But you see that, if you're not on track to end up in the ideal position that you want to be in, there's some things that you need to do to what we call jump the line. Making sure you're doing better with your investments, that you're optimizing with your tax position, that you're doing all of the things that you can to build that money momentum. And once you do jump the line, that it actually becomes easier, that you just need to follow the bouncing ball and keep on track to end up in that position. But the longer we wait, and I sort of touched on this before, that you see that the jump that you need to make becomes more and more difficult. This one can become impossible, that you just in terms of the sacrifices that you need to make. Now, this is something that I used to see quite a lot when I was first sort of started working in financial advice. I was working in a fairly traditional company that people would leave it too long, and they would end up just waiting and not prepared to make the sacrifices that they need to get the results that they want. So the sooner you start, the easier it is. And it doesn't matter if you want to, what your goals are. If you want to save and invest, if you want to build 10 grand in passive income, you need to save X dollars today. If we wait a month, a week, a year, 10 years, then it's X plus, 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 plus. So the sooner you start, the easier it will be. This quote from Derek Sivers, I think, is a good one to leave you with, which is all about, and for anyone that's watched any of the previous presentations, you see I use it a little bit, but it sort of talks to the fact that, if information was the answer, we'd all be billionaires with perfect abs. And it's very true that we don't need more information. What we need to do is take action to get results. And the key to taking that action is to use focused knowledge. So you guys have made a great start on that today. Well done in jumping on, and I hope it's give you a push to get started. But you need to keep capitalize on that momentum. The first step is the hardest. So now build your momentum and focus on moving things forward to get the results that you want. So guys, I hope you found that helpful. I'm going to jump into Q&A in a sec, but just before I do, for anyone that needs a bit of a push to get started, we do, this is our bread and butter, what we do, helping people with the sort of stuff that we've covered off today. We do these, one of the things that we do as a business is these one-on-one money breakthrough sessions, which is essentially a 45-minute session to help you get clear on, the opportunities for you when it comes to your money, clear some of the roadblocks, what are the things that are slowing you down or holding you back, and also give you an opportunity to get your questions answered. I've got the link here, which I've also popped into the chat box. We're discounting these sessions for the people in the GA community, and we do donate all of the money raised from these to charity. I'm pumped that last year we raised 20 grand, but in January we've raised 4,500 and change so far. So that has helped us. We've got a partnership with Buy One, Give One, or B1G1, which is a global giving initiative where every time someone does business with us, we do something good in the planet. Last year, with the money that we raised, we built 2 houses for underprivileged families in India, as well as supported a bunch of people throughout Asia and Africa with access to hygiene and nutrition, sanitation, and water and stuff as well. So we'd love for you to get involved and help us continue that process. Also learn some money stuff at the same time. These sessions are perfect for people that are saving at a decent rate, so that you've got which means you've got the ability to actually capitalize and take some action, have a decent chunk of cash to invest or equity in a property, or for anyone working in tech companies with RSU, ESPP, employee share plans, that sort of stuff as well. And yeah, the link is there. Again, the link is in the chat box as well for anyone watching along. Would love you to get involved in that. And yeah, I'm going to jump over to Q&A here. They've got a question that just popped into the box about can you claim this session on tax? Look, I'm not allowed to say yes to that question, but I know an accountant that would. A bit of a weird one with the compliance side of things, but I would say that I think any sort of self-education expenses the ATO has deemed are tax deductible. So if I was doing the session, I would be claiming it as a tax deduction. I hope that you can read between the lines on that one. So I got a question here. Hey, I have 60K in a savings account and would like to invest it in property in a year or two. In the meantime, should it be in my bank account or should I invest somewhere like ETS or government bond? Thank you. So yeah, that's a good question and a common challenge that I see people, sort of working through with this stuff as well. That if you've got money that's earmarked, say, for a property purchase, but not sure. Obviously, the interest rates are crazy low at the moment, so they're not really doing very much. Not really doing very much for you with that cash that's there. But so I see that they want to make it actually happen now, or do something with the funds. Now, the thing is that when you invest into shares or share type investments, that there should be you should have the ability to hold the investments for 7 to 10 years or more. Now, that's because if there is a market correction or downturn, that you want to be able to hold the investment so you're never forced to sell them when the market is down. That being said, if you had invested 12 months ago or 2 years ago into the share market, it's likely that your investments would be significantly higher than where at the time that you invested. At the time that you initially invested, and therefore, if you were to, if you wanted to sell now, no problem at all. And in fact, that could be good to take some profits. Now, that being said, if the COVID thing had continued and the markets were to continue to slide, then we don't know what could happen. So you don't need to want to have the investments invested for 10 years or more, but you need to have the ability to have it invested. So I suppose it's a long-winded, but it is a bit of a curly one that you don't want to get wrong. That I speak to a lot of people that want to buy a property. Now, they would ideally like to invest in property in a shorter term time frame, but so long as you have the ability to hold the investments for longer, if you're prepared, if you want to invest now and start making some money now, and know that if it all goes well, you'll take it out in a couple of years and go buy your property, then that could work really well. But if it all turns south, then you just, so long as you can delay that property purchase, then you can get your money working for you now. So it's really a trade-off. Now, I know that there's no one set answer there, but it really depends on you. So I hope you found that one helpful. Thomas says, tax is hard. How can we get someone to help us with our investment tax plan without paying thousands to a financial advisor? Or look, you could ask your parents, a bit tongue in cheek, but you could ask your parents or your mates. You might get some advice. It certainly won't cost you thousands of dollars paying for a financial advisor, but I think if you want good advice, then you need to be prepared to invest in that advice. Now, that will generally pay for itself. I mentioned before, like a good advice should be a profit center, not a cost to you. So I think if you're going to save, like I suppose maybe the question is, if you're going to save thousands, how much do you think you should pay for advice to help you save and grow thousands or tens of thousands of dollars through investments? Jade says, what level net wealth do you want to be meeting with a financial advisor? Look, Jade, I don't think that there's any specific level. I think you need to have the ability, if you're meeting with a financial advisor, you need to have the ability to benefit from the advice in excess of the fees that you pay. You know, it's a value exchange like any service. You need to get value in excess of what you pay, or at least value at the level that you pay. So, you know, if you've got very limited assets and you've got a low income and you can't save that much, then it's going to be hard for an advisor to create, you know, a bunch of money for you. But if say you had very limited assets, like we've worked with people in the past that have limited assets but really good incomes and they're saving fairly strongly, in that case, there's a lot of value there to do that. So I think it really depends, and it depends on the advisor as well. If you go to a really traditional firm, they're going to want to manage assets for you, or manage an investment portfolio, and probably turn you away. Whereas I think if your work, like the work that we do, is strategy first, and that means that it's not really relevant necessarily what level of assets you have. Obviously, it dictates the options that you've got, but doesn't actually matter. So yeah, I hope that was helpful. Jade. Reese says, how do you feel about acquiring debt for investments? Of course, this is very based on a person's situation, but what is your general view? General view is that it's really great. I think, debt, as long as you've got a reasonable interest rate and as long as the expected return on your investment is good, I think gearing is fantastic because it accelerates your wealth creation. That's why buying property is so good. Shares and property, the returns are sort of similar, but if you've got 100 grand, you can go buy a $500,000 property, or you can buy a $100,000 share portfolio. A $100,000 share portfolio is not going to, a $100,000 share portfolio is not going to be able to compete with $1 million property. What else we got here? Hope you found that helpful, Reese. Amy says, how can I start learning about tax implications from investing, CGT, etc., if I don't earn enough to see a financial advisor? Well, that's a great question, Amy. Let me see. I've actually just popped into the chat, and I'll send this around afterwards, but I popped a link out to my podcast, not subtle plug for that. I actually just did like 8 episodes on tax planning, so you should get there's some good nuggets in there. Amy, check that out. There's a link through to the website too, and then across to the podcast channels on wherever you watch the podcast things. So I think that would be a good starting point. Money Smart from the government is a really great resource as well for anyone that's looking at upping their money knowledge, education. Money Smart website run by the government, super duper helpful as well. Hope you found that one helpful, Amy. Kate says, what's a good general idea for how much money one needs to live well in full retirement, not assuming we hope to have multiple houses and yachts? Okay, thank you for qualifying that, Kate. Look, I would say there are some, ASFA have, they put out these stats every year. The ASFA retirement standard, I just had to Google there. Pop that into the chat box there. Retirement standard, they have this thing, but it talks about like for a comfortable retirement needing like $50,000 a year. To me, that doesn't seem like enough, but I suppose it depends on what sort of lifestyle you want to live. And I think that, like I said, that if you look at how much you're spending now is a good place to start. And if you remove any like what we would call temporal expenses or things that won't be there in the future, rental payments, because we assume you've got a property under your belt that you've got a nice roof over your head, mortgage repayments, if the intention is, well, obviously you want to live debt-free in retirement, childcare costs, schooling costs, stuff like that for kids. If you strip all of those costs out that are only temporary, and then you're left with how much you're spending right now, I feel like that's a good starting point, because it says if you had enough money rolling into your bank account to live the way that you live right now, is that enough? And then that's a question for you to answer. Then just divide it by 5%, and that should give you a good starting point. It's not a rock solid equation, but it is a good starting point to say that if you need $50,000 a year, that 5% of $1 million, $50,000, that gives you a good starting point there. Kate, I hope you found that one helpful. David says, what percentage of total assets should you keep in cash? Well, again, there's no one right answer there, but I would say enough money to cover any upcoming expenses that you can foresee, as well as an emergency fund. And again, that's really driven by what you're comfortable with. I would say a good rule of thumb is 3 months of your fixed living expenses as a starting point. But, if you're a business owner or, if you're a business owner or you've got a lot, your tech worker with big tax bills rolling in and that sort of stuff, you probably want a higher amount, but that should hopefully be a good starting point. But yeah, totally get that you want to, you don't get a good return, like you don't get much of a return on cash. However, the return that you receive on cash is the benefit that you get by knowing that you've got a war chest so that you don't get caught short. Another one from David says, it's a good idea to pay off your mortgage or keep the cash for investments and keep the debt. There's probably no one right answer to that. I think looking at interest rates at the moment, though, interest rates are lower probably than the expected return on the share market. So that's one, interesting guideline to look at. Other than that, I think it really depends. Looking at debt recycling strategies and that sort of stuff, though, maybe you could have the best of both worlds potentially. Stella, Ben, what are your thoughts on dollar cost averaging versus lump sum investing in products such as ETFs or managed funds? When have you observed being the most effective? Look, I think generally if you've got a lump sum of cash and you decide you want to invest it, that sometimes, like what we did with some clients who were doing this in COVID, is we just dollar cost average, like they might have a big lump sum and we just average it in over a period of weeks that set the period that we wanted to be invested for, and then just did it methodically. We normally do it on Wednesdays to keep the weekend noise out of the way, and we found that worked quite well. But rolling forward, if you're doing it with regular savings, it makes sense to just dollar cost average as you go. Hope you found that one helpful, Stella. Yingdra says, when working, do they need your debit or credit card? No, I don't think so. No, I don't think I think a debit card would probably be helpful for day-to-day life, but not necessary for a job. You could just use a normal bank account or potentially cash. Don't give your debit card or credit card to your employer. Susan says, government and private bonds are good investment choice in the short or long term, and can we invest or should we invest more into shares? Look, I definitely can't give you advice, Susan. That's otherwise my compliance people would have me in all sorts of bother. But my personal view is that the return that you get on government bonds is really negligible. Like the additional uplift that you get on government bonds related compared to like just a cash investment is so small that to me it doesn't justify tying them up, tying up your cash. But it really just depends on you. But shares versus bonds are totally different investments in that one's a really defensive investment and one is a growth investment. So you want to get your asset allocation correct there before you make that investment. Vanessa says, what are the best things to do with money received from board with the plan? Will be given back with them when they need it. What is the best thing to do with money received for board with the plan that it will be given back to them when they need it, offset for my mortgage high interest account? Okay, I think what Vanessa is asking is about what do you do with board that you get from your kids? Look, I think that any of those things can be good. Offsetting your mortgage, you could probably do a calculation on that. You're giving the money back to them, so I suppose that there is a benefit there. It'd probably be slightly more beneficial though to put it into a share portfolio. I think you just need to be mindful though that minors get taxed as well. So I don't know how old your kids are. Probably they're old enough to earn an income, which suggests that maybe having an investment account in their name might be the go. You could also invest in your name and give it to them afterwards, although there's some capital gains consequences of that as well. Vanessa, so a lot of different ways to be right there. Riley asked about safety money. I think like we've covered that. Is there a way that a person can invest in quarantine the money so the other person in the marriage doesn't have access right to it if the marriage breaks down? The best way to do that is through a prenup. Or you could probably if you could do it in crypto. I don't know if that might help. Although I don't know the ins and outs on that, so don't quote me there. Look, I think that under the seriously though, under the laws, under the relationship laws in Australia and New South Wales, that it's probably that you're pretty stuffed there with the exception of having a prenup. That I think that assets created during a relationship generally form part of a financial settlement, unless you want to do something that's not technically on the level, which is hiding the asset somewhere in a way that they couldn't be seen, which obviously I wouldn't encourage. Prenup though, just have the difficult conversation. Ganesh says, is there any opportunity to get 20% investment returns? There probably is. There's probably some scam artist somewhere that would promise you a 20% return on your investments, but I don't think that there's any opportunity, which is I think what you're really asking to get that sort of return without taking a risk of sort of triple what the share market itself would have. Would be nice. So if you do find them, Ganesh, just feel free to flick me the link. I'd appreciate that. Rajesh, I sent through the budget standards as well. That's great. Thank you, Rajesh. I might put that link in the email that I send around afterwards. Got a couple ones. just before I wrap, SG says, what's your thoughts on delaying property purchase until later in life? Yeah, that can be good. I think it just depends on your plan and making sure that it fits. SG Reese says, opinion on credit cards. I think they're bad. I'm excited to get to the end of this Q&A. There's just 2 left here, which is great. Thomas is asking me a bit of a loaded question here. What's better value, a good tax agent or a good financial advisor? Well, I think you can probably guess my opinion there, but look, a tax agent will be cheaper, but a financial advisor will be more valuable. Wendy says, what training programs do exist to help set a solid foundation understanding money 101? Well, I think the stuff that we do is probably a good place to start. Check out my book as well. I'll send through some links, Wendy, for you to check out, and that should point you in the right direction. I'll send them to everybody. Cheers, guys. Well, that was great. Well done. Sorry again about the confusion with the time. Yeah, hope you enjoyed that. Love the feedback. We'll send around some stuff and go from there. Cleo?
Thanks, Ben. Thank you so much, everyone, for joining us. I've just popped in the links again for the feedback form in the chat, and as well, if you want to book a breakout session with Ben, that is also in the chat as well. But thanks so much for joining us. We hope you really got a lot out of the session. Feel free to pop your feedback in the link there, and we hope you can join us next time.
Cheers,
the session is recorded, currently still being recorded, and so we'll get that to you guys as soon as we can after the session as well, with all of Ben's links and all of his feedback. Thanks,
awesome.
everyone.
Thanks, Cleo. Cheers, everyone. See you next time. Cool.